SEC, DOJ investigate FTX, regulators suspect crypto exchange mishandles customer funds. The U.S. Securities and Exchange Commission, SEC, and the Department of Justice, DOJ, are reportedly investigating cryptocurrency exchange FTX. The crypto firm is suspected of mishandling customer funds and breaking securities laws. Regulatory probes are among the key reasons why Binance walked away from the acquisition of FTX. U.S. regulators and the U.S. Department of Justice, DOJ, and the Securities and Exchange Commission, SEC, are looking into the turmoil surrounding FTX.com and its liquidity crisis, Bloomberg reported Thursday, citing a person familiar.
Ready to go public, so.
That was Coinbase's CEO, just a few weeks before the company scored an $85 billion valuation in its stock market debut. Since it was founded in 2012, the company has grown to be the largest cryptocurrency exchange in the U.S., thanks in part to its focus on making crypto accessible.
It's just going to be sort of an easy, seamless way for people to just get into crypto and trade it. And that was their idea.
It helped the company bring in record revenue in 2021 as more traders joined the platform. But as Bitcoin and other cryptocurrencies fell, Coinbase's share value fell along with it, exposing deeper issues with its business practices and culture. So, what went wrong? In 2021, the crypto industry was booming.
The Coinbase public listing on its own was driving a lot of enthusiasm for the rest of the market. This was seen as a bellwether news event.
The explosion in crypto drove more people, including many retail traders, to Coinbase's platform, and that drove up revenue in a big way. Most of the company's money comes from trading fees, which it charges two types of traders. First, retail.
Who are basically, mom and pop, young kids, people like you and me, people just kind of doing this out there on their own.
And second, institutional.
Brokerage houses, pension funds, hedge funds. I mean, people who are out there who have a business that is predicated on your trading assets in the capital markets.
Much of Coinbase's trading volume comes from these traders, but most of their revenue comes from these ones, who make up its core customer base. In the second quarter of 2021, 90% of Coinbase's $2 billion net revenue was made from retail transactions alone. Spurred on by a growing user base, Coinbase set its sights on growth. They beefed up on hiring, aiming to catch up crypto assets and products. Between the end of the first and third quarters, it added more than 1,000 employees. In October, Coinbase announced it would launch its own NFT marketplace. And in November, the share price shot to a high point as the value of Bitcoin peaked. But there was trouble ahead, especially for a company that relied on crypto enthusiasm.
These things are all lashed very, very tightly to sentiment in the crypto markets. In the stock market, stocks like Coinbase become a proxy for the crypto markets, and that's why you see the stock prices track crypto so closely.
As the Fed began to shift its monetary policy to tackle inflation, many professional investors started to pull out of assets that they considered riskier.
Crypto became sort of one asset in a larger portfolio. If you're a professional trader, you buy bonds, you buy stocks, you buy commodities, you buy currencies, and now you are buying crypto. So you were slotting crypto in among those different assets. And where it ended up being slotted for most of them was a risk asset. It was a highly volatile asset.
In April, Coinbase's share price dropped steeply as trading volume fell and analysts slashed estimates for earnings. Transactions were down, and retail traders were pulling out of the market. Some were hodling, shorthand for holding on for dear life. It means that they were sitting on their cryptocurrencies, trying to ride out price declines and hoping to come out on top at the other end. That also means that they were making fewer trades and transactions, the main things that Coinbase relies on to make money. The stock price continued to slide in May, when the company reported losses in the first quarter.
When you started to see business results come in, and the business results were really bad, I think that's when people started to realize that this was not just one of crypto's sort of periodic common spasms.
As trading continued to slow and revenue...
Certainly early in 2022, it was hard to tell how severe the sell-off was going to be. There wasn't a lot of panic, and you saw companies like Coinbase, they kept hiring. They were in expansion mode, and they just kept running with that despite the fact that the prices started to fall.
The company hadn't built up other streams of revenue in time to make up for falling profits. The NFT marketplace they had announced in October didn't materialize until April, just as the NFT market was flatlining. The platform did just 4.2 million in transactions between when it went live in April and the beginning of August. Coinbase has also offered things like staking and custodial services.
Now, especially, it's just a really hard time to try to build new businesses in the middle of, completely down market.
In early June, a petition, purportedly from Coinbase employees, was posted to another crypto site. It called to oust several executives over the company's performance. Armstrong tweeted that the petition was really dumb on multiple levels.
I think probably issues that were inside the company that largely were papered over because times were so good in 2021 started to emerge in 2022.
A few weeks later, the company announced it would cut its workforce by about 18% to reduce spending. Its employee count had grown to nearly 5,000. And Coinbase ran into more trouble in July, as federal authorities charged a former product manager from the company with insider trading. Lawyers for the former product manager said that the charges were meritless. The SEC also took the position that several of the crypto assets traded on the company's platform are classified as securities. The company, which isn't licensed to operate as a securities exchange, denied that the assets qualify. By the end of Q2, the retail trading volume fell by 74% from the high in Q4 of 2021. To make up for lost ground, Coinbase plans to continue to grow its other streams of revenue. In June, it launched a derivatives product that allows traders to bet on the price of an underlying asset. The company announced a partnership with money management firm BlackRock in August, which could help increase the number of institutional investors that use the platform. Coinbase says that it has built up more client-requested products and is seeing a strong uptake. Armstrong told CNBC in August that the company is planning on increasing its earnings from subscriptions and services, which made up about 18% of its Q2 revenue.
We're realizing that trading fees is not going to be that thing that it's still going to be a major part of our business in 10 years from now, even 20 years from now. But I'd like to get to a place where more than 50% of our revenue is subscription and services.
Businesses across the crypto industry have been impacted by the downturn, but competitors like Binance and FTX have continued to grow and are gaining market share of spot trading. However, since neither company is public, it's not clear how much their earnings have currently been impacted by the market. In its Q2 letter to shareholders, Coinbase said that it lives by the mantra, "It's never as good as it seems, and it's never as bad as it seems," and that it is an all-weather company with experience in navigating crypto asset price cycles. The company's share price has seen a small increase in recent months. Coinbase says that it continues to take a